Greetings, my name is Kevin Matthews and I am the tax professor. I want to welcome you back to class. Remember, class is still in session because the learning never stops. And I want to welcome you back to this. This is the second part of the foreign tax credit video that we're going to try to shoot. And if you probably didn't notice it during the first one, I was starting to notice it was going longer. And I kind of gave an estimate as to how long it would take to do the foreign tax credit if we talked about the entire foreign tax credit. I gave the example of it probably taking about an hour. I'd like to revise that. Say it probably actually take about 2 to 3 hours. And if we did the corporate tax credit, it could be a day-long video. And so what I really wanted to do here, we talked about in the past video where we gave some of the generalized sort of things that kind of went on. And so in this video, what we're going to do is that we're going to focus on the form, the foreign tax credit form, which is Form 1116. And that's the foreign tax credit form for individuals and then for estates and trusts. Now, there is a corporate tax corporate tax foreign tax credit form, the 1118. If you ever take a look at that, that is a monstrosity, to say the least. It's huge, and it would take a long time for us to be able to shoot that video. And so I decided that I wouldn't even try to do that because there's just going to be so much. Also, what we talked about in the first video is there's these 7 baskets. In this video, we're going to really only focus on the 2 primary baskets of passive and general, and the other baskets that we kind of talked about in the other video, we're probably not going to have time to be able to cover any of those other baskets. Something that and just talk a little bit about the history before we get to the form. The foreign tax credit really went through some pretty amazing changes. Foreign taxes, international taxes as a whole went through some pretty amazing changes, and that's because the United States moved from what we would call a worldwide tax system to what's called a quasi-territorial tax system. Now look, I'm not trying to throw out fancy words. I don't need $3 words to make this video go any longer than it has to. But from your perspective, what that means is that they've changed the system significantly in that time period as a result of the Tax Cuts and Jobs Act of 2017. And as a result of which they expanded the baskets. There used to be a lot less baskets, and now there's new baskets. For example, the 901J is a good example, and then of course the branch tax is another example. And what they're trying to do is with the new forms, what they're trying to do is really sort of narrow down what the purpose of those taxes were paid for, and make sure that there's not a whole lot of funny business going on, and so that they really work hard to make sure that that gets done. This is basically the top of the page for the Form 1116, and this is the 2019 version. And so you'll take a look at it, and of course you got name, identifying number, which the identifying number generally is going to be your Social Security number. For an individual, for an estate and trust, it's probably going to be an EIN, and so that gets put up on there. And then you've got these various the baskets, the 7 baskets that we talked about: the 951A, the foreign branch, passive, general, 901, certain income, resource by treaty, and then of course the lump sum distributions. And so what's ended up happening is they broke these out so that they can make sure that if you do have some income that happens as a result of 901J, you can't take that against your general income category all willy-nilly. And so, and I want you to understand, 951A, 951 Cap A, as we would say, and then Section 901J and foreign branch category, more likely than not, is not going to affect, I'd say, 95% of the people who are going to use the foreign tax credit. The majority of the people who are going to be that are going to get affected, that are going to need certain categories on this, is going to be passive category, and then of course the general income category. And if you take a look at all of that, you'll basically notice that there are These are the two categories that most people are going to have. You know, and then of course later on you'll put the resident name of country. Basically, what you'll do is that and usually what this will end up happening is that we put the resident of where you are. So this coordinates a little bit with the 2555, which is used on the the foreign earned income exclusion. And so you want to make sure that you put down the residency of your the country that you're an actual resident of during this time. And that's kind of helpful. It's helpful a little bit with the general income category. Now, does that mean, say for example, I'm a resident of Germany, does that mean that I can't have foreign taxes that are going to be due in Ireland? Do I have taxes that can't be due in England? No, and the reason for that is that maybe you're traveling as you work in Germany, and say for example, you know, they send you on a 5-week business trip to Ireland. All of a sudden, you know, you're paying taxes in Ireland as a result of all that. Now, there's some ways to get out of that, but you know, we're not going to talk about that in this video. And so this area, what'll happen is that you're going to fill out, you know, name, what type of foreign income tax that you're being affected by, and then of course the residence. Now, I want you to understand, if you have passive foreign tax credits, if you have general foreign tax credits, both, you're going to file two 1116s in order to be able to claim those credits. You have to. I mean, that's just kind of the way that this works. So that has to happen. So it is potentially possible you could have up to 7 different foreign tax credit forms. I mean, I would say that if you have 7, it's ludicrous. More likely than not, you're at the most, I'd probably say you're going to have about 3. And you know, generally speaking, if you've got and usually where you're going to see box A, B, and E is when you're a part of what's called a controlled foreign corporation, or a CFC, and then you've got some credits that are flowing through to you because you have foreign income that you're being charged, you know, some part of income and other types of income, and you kind of come back and say, hey, you know, there's some foreign tax credits that we paid on this income, and therefore I want to get credit for it. And there's certain elections you have to do in order to be able to do that. So it's very wonky. It's not something I want to get into, and all that stuff. So the next part of the form that we have here is that, you know, you're going to have, you know, taxable income or loss from sources outside the United States. Now, you'll notice that they have foreign country or U.S. possession. There are 2 U.S. possessions that you can definitely have a foreign tax credit, and that would be Puerto Rico and Guam. You know, if you pay taxes to those jurisdictions, you technically get a foreign tax credit to be able to go against this. Now, again, that's something, if you're running into those issues, you want to make sure that you're talking to a tax professional that is a specialist in that area. And something I've noticed is that in the territories of Guam and Puerto Rico, there will actually be people who specialize in this, you know, in order to make sure that people get the tax credits that they need. But you will notice that they do have country A, B, and C. Now, it is entirely possible. And I told you in the last video, I was working with a guy who was a salesperson who traveled between 30 and 35 countries. Now, he wasn't taxed in all those countries. Most of those countries he didn't pay any taxes whatsoever in. But in theory, if he did, and I think his foreign tax, I think we ended up claiming foreign taxes in 9 countries as a result of his work. And so what happened is that he had a pretty large, 1116 that we had to file in order to be able to get it. So what'll happen is that they're going to say gross income from source within country, and then the type of income. And so usually what you'll do is, you'll put down, like, for example, if you're getting a salary in Germany, you'll say wages, and then you'll put down whatever the income was. Gross. You don't put down, if there's any deduction, you don't put down net income, you don't put any of that stuff down. What you do is you put down the gross number. This one says, check 1 if compensation for your personal services as an employee is $250,000 more, and you use an alternative basis. That's beyond the scope of this. This is a technique that, not technique, but it's a rule that gets in, that if for some reason you have to use an alternative source of compensation, you'll actually put down, and you want to have that checked if that's the case. Okay, so the next section that you're going to have is kind of your deductions and losses. Now, expenses that are directly related to the income. So, for example, if you have a business, say you are working and going back here, and in country A, you work in Germany, and say you put down that you had, $200,000 of business income over there, you're going to put down the gross number. You're not going to put down the net income number that's on that Schedule C. And so what ends up happening is when you go to here, you're going to have expenses that are directly related to that income. That's when you're going to put down the expenses that kind of go with that. And then you have pro rata share of other deductions not definitely related. And these are, so for example, certain itemized deductions that you have on your U.S. tax return. A very good example of this would be, there's certain itemized deductions that kind of go onto this, and you'll put all that stuff down, or the standard deduction, and it could be one or the other. And part of, and look, let's ask, why are they doing this? And I think that's important. The reason why the IRS is doing this is that, remember, your ability to take a foreign tax credit is going to be based on how much you paid to the other jurisdiction, or how much that same income would have been taxed in the United States had it been taxed solely in the United States. So they have to kind of come to that number as to what it is in order to be able to make a determination that says, yes, this is how much the tax would have been if you had paid this in the United States. And then, and then of course, once they have that number, that's how they're going to make the determination as to how it happens. I'm going to be honest with you. I mean, I've been doing this for years. I have never actually sat down and written this stuff out. Usually what happens is we put it into the computer, and the computer kind of runs its mathematics. And so, and that's generally how these things normally go. And then you're going to add foreign source income, gross foreign source income, and then gross income from all sources, so that you can get kind of a pro rata amount. And then, then it's going to have the divide line this, money, that, then take out your home expenses, mortgage interest expense, and then losses from foreign sources, and add it all together, and you're going to get this nice little number that's going to come down to 7. Now, remember, this is being done at the 3 different countries specifically. So after you put the names in the countries that are here, they're going to kind of take a look at it. They're going to say, okay, this is what the income is. Now, another reason why I think the IRS wants people to do this is they want to see, they want to make sure that what you're claiming is reasonable. So if you live in Germany and you put down that about 40 to 50% of your income was tax, that your tax that you paid was on 40%, 40 to 50% of your income, that's a pretty reasonable number for Germany. So that's just kind of the way that works out. Now, so if you did the same, if you put down the exact same numbers and it was Bermuda, the IRS is probably going to scratch their heads and go, yeah, you probably need to prove that to us. And it could be subject to audit. Now, my personal opinion, put down the truth. If you put down the truth, yeah, if they come to an audit, so what? Yeah, you sit down with the IRS, you explain it to them, they get it. If you can prove it, and prove it, one of my friends used to say, when you're making decisions on whether you want to take a deduction or not, the question I always ask myself is, could I stand in front of a judge, raise my right hand, and say, yes, Judge, on my holy honor and on my eternal soul, I swear to God that this was accurate. If I can do that, it's generally a pretty, my opinion is it's a good thing to do. Now that doesn't mean that you need to be worried about this. Generally speaking, you put down what the truth is, it's going to work out for itself, and I wouldn't worry too much about that. The next part that they've got is going to be the part 2, which is the foreign taxes paid or accrued. Now, I want to talk about this box down here, which says credit claim for taxes. You must check paid or accrued. Paid is the default. You can elect to do accrued. Once you elect to do accrued, you must request IRS permission to no longer do accrued. And part of the reason why the IRS does this is they don't want you playing games with this. Okay? They don't want you to say, oh, this year I'm going to use paid, next year I'm going to use accrued, then I'm going to use paid again, then I'm going to use accrued. It gets to be too difficult. And so now the big difference is, what's paid? So does that mean that I have to actually sit there and stroke a check out to the tax authorities? And my answer is kind of. Money has to be taken from you and remitted to the tax authorities to be considered paid. Okay. And so what will end up happening is, very good example. Here in the United States, you work for a job, and what ends up happening is that we withhold taxes from your paychecks because that's what we're required to do, and that is considered paid as of the end of that year. Because basically, what happens is when you get to the end of the year, they're going to figure out how much you pay, and they're going to issue you a statement that's going to consider that. And so the accrued is basically saying, look, I know for a fact that on this income that I've made, say $100,000, I'm going to pay 40% taxes on it. And so I anticipate that I will pay $40,000. Now, how do you determine that accrued amount? It's going to be based off of whatever you file on your tax return in that other country. So for example, and the place where we tend to run into this the most, when we want to use accrued is if taxes are generally not withheld until it's not paid until the end of the cycle, where they just ask you to stroke a check. Now, most systems don't do this anymore, but there are some systems that do not have a withholding requirement. If they don't have a withholding requirement, what will happen is you're going to want to do accrued. Now, the other thing is that if you have income that is being determined at different phases. So, for example, in England, their income is actually determined. So their tax year goes until April 5th. And part of the, why April 5th, I don't know. And I've never, I've asked British people about it. I've gotten multiple answers, and I don't want to make an assumption as to what the correct answer is. But with this, what would end up happening is that you would want to consider whether you do paid or accrued. Now, with England, normally I do paid. And generally, those taxes are going to be withheld anyways. So as long as you can calculate how much the paid amount of that income is at that point, you're going to do fine. I don't think you're going to have any issues. Normally what we do is we ask our British citizens to say, or British expats basically to say, hey, give us a copy of all of your pay statements. We'll figure out what the amount that paid is, and then we kind of go on with that. I've seen where accrued is very common. Canada is a very common one, because maybe we, in a very good example of this, I had a client once who he did some consulting work up in Canada, and then, and he was only there for about 3 months. They withheld taxes, but he knew he was going to have to pay more. And so what he did is he said, look, they didn't withhold enough taxes out of it. And it was actually a mistake by the agency that he was working with. They didn't withhold the taxes correctly. So what he did is he said, look, I'm gonna have to pay these taxes. And he because of the fact that he was going up and down to Canada all the time, he wasn't going to qualify for a treaty position. So basically he was going to have to pay it. And so what we did is we said, look, we can figure out what your taxes are going to be. We're going to say this is how much it is, and then we just did an accrual, and as a result of which he got to take the full taxes in the year where the income was earned, as opposed to, and that's where you could run into some issues, because if you think about it, say for example I make $200,000, and then I don't pay any taxes on it until the following year. Well, the problem that you're going to run into in the United States, you're going to file the tax return. You're going to have $200,000 of Canadian-sourced income in the United States, Canadian-sourced income on your U.S. tax return. And then what's going to happen is that when you actually stroke the check to the Canadian authorities in the following year, maybe you don't go to Canada at all the next year. And as a result of which, you're not going to have any Canadian-sourced income at that point. And so that's when we're going to kind of take a look at this and say, yeah, we want to do accrued. If you are doing your tax returns on your own, you want to be very, very careful before you check this box, because it can really cause some issues if you decide to go to and from. Date paid or accrued, 9 times out of 10, we always use 1231 on this. I don't think it's really as important. If you've got like wages, we're not going to sit down and we're not going to write down every single time that you had taxes withheld from this. That's just ridiculous. What's going to happen is, say you're in Japan, you're working in the JET program, so maybe you're working there for the entire year. They withhold taxes from you for the entire year, And what will end up happening is that we just say, hey, they withheld X number of million yen, not million, I'm sorry, 100,000 yen in taxes, convert to the United States dollar, and that's how this gets filled out. But we're going to put down 1231 if that ends up being the case. You're going to report taxes withheld at source on dividends, royalties, interest, or other foreign paying taxes. Again, if it's wages, it's going to be other. But if you've got dividends, you're going to put it down on dividends, interest, and then, of course, your royalties and rent if you have a rental property overseas. And then you're going to convert that to dollars. Now, some people will ask me, okay, Kevin, where do I get the foreign tax rates to do this? Now, this is a tricky question, okay? Which rate do I use? Now, if you are withholding your taxes throughout the entire year on wages, my recommendation is use the IRS rate. Okay, and the IRS will publish their rates on their website. You go and you do a search for foreign exchange rates in IRS. They'll have an actual rate that they can use. That's the official rate. Now, if for some reason you have a different rate to use, you better be able to back it up. But my recommendation is use the IRS one, then don't move on with it. If we're talking significant amounts of money, maybe I'll try to find a different rate that's more favorable. But generally, if it's withheld throughout the year, you can go ahead and use the IRS rate and move on. Now, if, say, for example, my client's example where he went up, he worked for 3 months, got paid at the end of his contract, and they, at that moment, withheld the taxes. In that case, we would actually put down the date it was on paid, and then we would go ahead and do what's called a spot rate. And spot rates can come from a number of sources. But generally, because most currencies are traded on the open market, so it's not a problem. It's not difficult to get. And so what ends up happening is people will go and then they'll go get the spot rate at that time. Or, for example, you sell a house in Canada and you pay taxes on it. And so what ends up happening is you say, okay, I sold the house in Canada. They took $40,000 Canadian from me as part of that taxes. I'm going to put out other taxes paid or accrued, $40,000, and then I'm going to convert that to the United States on date it was accrued. And then that's basically where you're going to do this. So again, this is difficult. This is probably something that you want to be working with a tax professional, a CPA, EA, or tax attorney to end up helping you out. Part 3, this is where basically what they're going to do is they're going to say, okay, part 1 you calculated what your income was, and then these are your foreign tax. I'm sorry, yeah. So these are your the foreign taxes. Carry back, carry over. Again, taxes can go back 1 year, forward 10, and so you can kind of do that. So what they'll end up doing is you're going to put that down. Again, most of the time with me, my tax software is actually calculating a lot of this number. Now, that doesn't mean I don't take a look at it and make sure it's correct. I've seen a couple times where my tax software made mistakes, and so we catch that, and that's usually something that we spend a lot of time in. Reduction of foreign taxes. This is going to happen if you want to see the instructions if your case applies. A very common thing with this. Treaty resourcing. You could also have foreign earned income exclusion. So if I say, for example, the foreign earned income exclusion is $140,000 and I make $200,000 in Germany, I'm only going to be able to take the foreign tax credit on the delta between $140,000 and the $200,000, which would be $60,000. So I would have to reduce my foreign taxes that's attributed to that $140,000 and that's how much the reduction is going to be. Okay. Taxes reclassified under high tax kickout. This is this is under high taxing authorities, where there's obscene tax rates. Again, if you're running into one of these circumstances, you better be hiring somebody. This is something that people who actually deal with this, and I don't want to go into it because it's a lot. So it's going to make the video even longer. Then what's going to end up happening is there's going to be some other boxes that have to get filled out here. Again, most of the time this is going to be done by the calculations in the software, but nothing that you really need to be concerned with at this time. But again, if you have any questions about this, the Form 1116's instructions are pretty comprehensive. I actually, it's funny. A joke that I've said to people, and I shouldn't say joke because that sounds mean, but I always said, one of the jobs that any English major can easily find if they really want to is go work for the IRS, because they actually write those publications. English majors write those publications, basically using the like I said, they use English majors to translate tax code into workable documents, so that the average, actually my understanding is they're supposed to write them to the 8th grade level. So the people in the 8th grade, I have some opinions as to whether they really write them to the 8th grade level, but and that's not the knock on the people. I know they're working hard. They're trying to do something very difficult. Take something that's legal speak and make it into English, which is not something that can always be done very easily. And so that's kind of important there. This right here is going to be the summary of tax credits part. So what's going to happen is, on your last page of your 1116, obviously, say for example, I have taxes in the passive category, I have in the general category, and we'll say that I had some tax credits for some lump sum distributions that I did. Maybe I'm gonna have 3 different sets of documents, and so what the IRS likes to do is have a summary page that they can go to saying, what's going on here? And so that'll calculate this out. Again, most of the time tax software takes care of this, but you want to make sure that it's flowing through correctly. I've seen once where there was a mistake and we ended up having a paper file as a result of that, because I had to physically change this. And then what's going to happen is they're going to take all of this together and they're going to say, okay, this is what your foreign tax credit is. You're going to put that on Schedule 3 of your 1040. If it's on 1040 NR, which is unusual, or if you have Form 1041 Schedule G line 2A, or if you are Form 990T, which is if you're a not-for-profit that has a side business, this is where it's going to end up being. All right, folks, so that's all I got to say. Again, I tried to truncate this video as much as I could, and we still got to around 30 minutes for this one. Again, I want to say thank you very much for watching the video. If you like this video, please go ahead and hit the like button. And then if you like the video series, please go ahead and hit subscribe. We'd really appreciate to have that there. And then but if you want to reach out to us because you have any questions or you want to talk about any of this, you can reach out to us on our website, which is www.betasolutionscpa.com. Again, it's www.betasolutionscpa.com. And I want to say thank you very much for watching.